The radar that watched everything, the system that saw every missile, every aircraft, every movement across the Persian Gulf is gone. Iran didn't fire blindly. They knew exactly what to hit, and they hit it. A $1.1 billion early warning system, destroyed in a single precision strike. The eyes of America's entire Gulf defense went dark. And what happens next could change everything. Welcome to Currency Archives. If you've been with us for a while, you already know we don't do panic here, we do facts. Now, if you're watching this and you still haven't subscribed, think of it like this. You wouldn't leave the house without your glasses, would you? Don't watch the world fall apart without us either. Hit that subscribe button. We'll always be here when things get serious. And before we begin, drop a comment below and tell us, where in the world are you watching from today? Because this story affects all of us. On a night that would quietly rewrite the rules of modern warfare, the Persian Gulf changed forever. No declaration, no warning, no diplomatic signal, just a missile. Precise, deliberate, and devastatingly accurate, cutting through the night sky over Qatar and finding exactly what it was looking for. The target was not a tank, not a runway, not a fuel depot. It was something far more valuable than any of those things. It was the eye. The AN/FPS-132 radar system, known among defense analysts as one of the most sophisticated early warning installations ever deployed in the Middle East, had been watching the skies over the Persian Gulf for years, quietly, constantly, without interruption. It tracked aircraft, it monitored missile trajectories, it fed real-time intelligence to U.S. command centers across the region. Every movement, Iranian, Russian, Chinese, passed through its field of vision. Military planners on both sides of the Atlantic slept easier knowing it was there. It cost the American taxpayer $1.1 billion to build and deploy. It was destroyed in a single strike. When the Islamic Revolutionary Guard Corps announced the operation, they did not speak in the language of anger or revenge. They spoke in the language of calculation. Iranian officials stated that the strike was a precision missile operation targeting American defense infrastructure. Not a random escalation, not an emotional response, but a carefully selected move in a much larger strategic game. That distinction matters enormously, because this was not about destroying hardware. This was about destroying certainty. Qatar was not chosen by accident. The small Gulf nation hosts one of the most significant U.S. military presences in the entire region. Al Udeid Air Base, located just outside Doha, serves as the forward headquarters of U.S. Air Force's Central Command. Thousands of American personnel operate from its grounds. Billions of dollars in military equipment pass through its infrastructure every year. For decades, Qatar existed as an untouchable zone, a place where American military power projected confidence so loudly that adversaries simply did not challenge it. That assumption ended on the night of the strike. When Qatar's own air defense units confirmed they had engaged incoming missiles during the exchange, it told the world something important. It told them that the Gulf's most protected real estate was now inside the battle zone. For the business community watching this unfold from trading floors, boardrooms, and investment offices around the world, that confirmation was not just a military update. It was an economic signal. Consider what the $1.1 billion radar actually represented beyond its technical specifications. It represented the foundational promise of U.S. Gulf security, the invisible guarantee that sat beneath every oil shipping contract, every regional investment decision, every insurance policy written on Gulf-bound cargo. When global businesses calculated their risk exposure in the Middle East, they factored in American military presence as a stabilizing constant. The radar was part of that constant. It was infrastructure, not just for defense, but for confidence. Confidence that kept oil flowing, confidence that kept shipping lanes open, confidence that kept capital moving into the region rather than out of it. That confidence now has a hole in it. The entrepreneurs and decision makers who understand history know that the most dangerous economic moments are never the ones that make the loudest headlines. They are the quiet structural failures, the moments when a load-bearing wall of the global system cracks, and most people mistake the dust for ordinary weather. This was one of those moments, a $1.1 billion eye, gone in seconds. Not replaced next week, not rebuilt next month. The waiting list for systems of this complexity runs into years, and in those years, the Persian Gulf will look fundamentally different than it has looked for the past 3 decades. The question every serious business person must now ask is not what happened that night over Qatar. The question is, what does the world look like now that America can no longer see what is coming? There's an old principle in economics that most textbooks never teach. It is not about supply and demand. It is not about interest rates or inflation curves. It is simpler than all of that. It says this: markets do not run on money, they run on confidence. And on the night that missile found its target over Qatar, a very specific kind of confidence, one that had been silently underwriting trillions of dollars in global trade for decades, began to quietly unravel. Most people did not notice. The serious ones did. To understand what was truly lost that night, one must first understand what the Persian Gulf actually means to the global economy, not in political terms, but in pure mathematical ones. Approximately 20% of the world's entire oil supply moves through a single narrow corridor of water called the Strait of Hormuz. 20%. That is not a regional statistic. That is a global one. Every factory in Germany that runs on energy, every shipping vessel leaving Singapore, every airline calculating its fuel costs for the next quarter, every pension fund with exposure to energy equities, all of them, whether they know it or not, are financially connected to what happens inside that narrow stretch of water. And the radar that was destroyed was the system watching over it. Within hours of the strike being confirmed, the signals began arriving. Not missiles this time, numbers. Brent crude pushed past $86 per barrel and continued climbing. Shipping insurance premiums across Gulf routes began recalculating. Maersk, one of the world's largest container shipping companies, issued a suspension notice citing what internal communications described as extreme military risks in the region. Qatar, for its part, halted crude shipments temporarily. Let that sit for a moment. Qatar, a nation that exports liquefied natural gas to Europe, Asia, and beyond, paused its operations because the security environment around it had shifted overnight. This is what a blind spot economy looks like in its earliest stage. Not a crash, not a collapse, a hesitation. And in global markets, hesitation is where fortunes are either protected or permanently lost. The Gulf Cooperation Council, Saudi Arabia, UAE, Kuwait, Bahrain, Oman, and Qatar watched this unfold with a silence that spoke volumes. These are nations whose entire economic models are built on one foundational assumption: that American military presence in the Gulf makes their exports safe, their infrastructure protected, and their sovereign wealth funds credible. When Qatar confirmed its air defense units engaged incoming missiles, it was not just a military update. It was a quiet acknowledgement that the old assumption no longer held completely. The UAE, which hosts its own American military installations, said very little publicly. But behind closed doors, in the offices of sovereign wealth managers and national security councils across the Gulf, the spreadsheets were already being revised. For the entrepreneurial class and business community watching this unfold, there is a critical lesson embedded in these early market movements. Economic disruption rarely announces itself loudly. It arrives first as a shipping delay, then as an insurance recalculation, then as a quietly revised investment mandate, then, only much later, as a headline that everyone pretends they should have seen coming. The businesses most exposed right now are not the ones with offices in Doha or Dubai. They are the ones who assumed the Gulf's stability was permanent infrastructure, as reliable as electricity or internet access, and built their supply chains, their energy contracts, and their growth projections on top of that assumption without ever questioning it. That assumption is now being stress tested in real time. The radar is gone, the eye is dark. And somewhere in the Strait of Hormuz, 20% of the world's oil continues to move through a corridor that the most powerful military on Earth can no longer monitor with the precision it once could. The markets have begun to price this in. Most investors have not. And that gap between what the market knows and what the average decision maker has not yet understood is exactly where the next great transfer of wealth will happen. There's a question that almost nobody in the mainstream media is asking. Not the television anchors, not the political analysts, not the defense correspondents filing their breathless reports from studio sets thousands of miles away from the Persian Gulf. The question is this: how long does it actually take to replace what was just destroyed? Because in warfare, just as in business, the most dangerous gap is never the one between what you have and what your enemy has. It is the gap between what you just lost and how long it takes to rebuild it. That gap in this case is not weeks, it is not months, it is years. And those years will reshape the global order in ways that most people are not yet prepared to think about. The system that was destroyed over Qatar was not something that can be ordered, delivered, and installed like commercial equipment. It belongs to a category of defense infrastructure so specialized, so technically complex, and so dependent on a narrow pipeline of contractors, components, and security clearances, that the United States government itself can only produce approximately 12 replacement-grade systems per year. 12. In a world where adversaries can destroy one in a single night, 12 per year is not a production line, it is a waiting list. Defense analysts who have studied the procurement cycle openly acknowledge that a full replacement of the destroyed Qatar installation, factoring in congressional budget approvals, contractor lead times, component manufacturing, testing protocols, and deployment logistics, would conservatively take between 5 and 6 years. 5 to 6 years. That is not a gap in defense coverage. That is a generational shift in regional power dynamics. Now consider the economic mathematics of what Iran actually executed that night. The radar cost $1.1 billion to build and deploy. The missile that destroyed it cost a fraction of that. This is the defining logic of asymmetric warfare. And it is a logic that has profound implications not just for military strategists, but for every serious business person trying to understand where the world is heading. Iran did not need to match American military spending dollar for dollar. They did not need aircraft carriers. They did not need stealth bombers. They did not need satellite networks or global logistics chains. They needed precision. They needed patience. And they needed to understand exactly which single point of failure, if removed, would cause the entire system to lose its balance. They found it. They removed it. And the cost-to-destruction ratio of that operation is a strategic blueprint that every adversary of American power is now studying very carefully. For the entrepreneurial mind, this concept is not unfamiliar. The most effective competitive disruptions in business history have never been the ones that tried to outspend the market leader. They have always been the ones that identified the load-bearing assumption, the single dependency that the entire operation rested upon, and quietly removed it. What Iran executed militarily that night over Qatar is something the business world would recognize immediately. It was not an attack. It was a disruption. And like all great disruptions, it did not need to be loud to be devastating. The replacement problem now facing American defense planners extends far beyond one radar installation. Multiple systems across the Gulf region have been reported as targeted in recent operations. Each replacement draws from the same constrained production pipeline. Each approval requires the same bureaucratic cycle. Each deployment requires the same logistical architecture. And while that pipeline slowly moves, the Gulf operates without the security infrastructure it has relied upon for 30 years. Secretary of State Blinken himself acknowledged in recent statements that American military stockpiles are running critically low, an admission that, in diplomatic language, translates simply as this: we cannot replace what we are losing as fast as we are losing it. That single admission, from one of the most senior officials in the American government, tells the business community everything it needs to know about the trajectory of this conflict. This is no longer a question of whether America will respond. It is a question of whether America has enough left to respond with. And the answer to that question will determine the price of everything you buy, invest in, and build upon for the next decade. Every major economic crisis in modern history followed the same pattern. Not a single explosion, not one dramatic moment that everyone saw coming, but a cascade, a quiet sequence of connected failures, each one triggering the next, moving through the system like a current beneath still water, invisible to most, until the surface finally breaks. What is happening right now in the Persian Gulf is not the crisis. It is the beginning of the cascade. And the businesses, investors, and decision-makers who understand that distinction will be the ones still standing when the surface finally breaks. Begin with oil. Because everything, every supply chain, every manufacturing cost, every airline ticket, every grocery bill, every interest rate calculation, begins with oil. Brent crude has already pushed past $86 per barrel and continues its upward trajectory. That number alone would concern any serious analyst. But the number itself is not the danger. The danger is what happens if the Strait of Hormuz closes, even partially, even temporarily. 20% of the world's oil supply moves through that corridor. A full closure, even for 30 days, would not simply raise energy prices. It would fracture the foundational assumption that global supply chains have been built upon for half a century. The assumption that energy will always flow. That assumption is now being tested in real time. And the market has not yet fully priced in what a prolonged disruption would actually mean. Now move to gold and silver. Because precious metals do not lie. They do not issue press releases. They do not hold diplomatic briefings. They do not soften their language for political audiences. They simply reflect reality. And right now, reality is being reflected very clearly. Gold has been moving with a velocity and consistency that veteran analysts describe as structural, not speculative. This is not retail investors chasing a trend. This is institutional capital, sovereign wealth funds, and central banks quietly repositioning themselves away from dollar-denominated assets and towards stores of value that no missile can destroy. Silver is following, and in some markets, leading. Physical silver premiums in Asian markets have already begun detaching from paper spot prices. This is a signal that the serious money understands something the casual observer does not yet grasp. When the military credibility of the world's reserve currency issuer comes into question, the currency itself comes into question. And when the currency comes into question, gold and silver become the only honest scoreboard left. This brings the analysis to the most consequential and least discussed consequence of the Qatar radar strike, the dollar's credibility problem. The United States dollar has maintained its position as the world's reserve currency for one primary reason that economists rarely state plainly. Not because of American economic productivity, not because of Wall Street's sophistication, but because of American military reach. The dollar is trusted globally because the military that backs it has, for 70 years, been capable of projecting power into any corner of the world and enforcing the rules of the system it created. When that military power is visibly degraded, when its infrastructure is destroyed faster than it can be replaced, when its own senior officials acknowledge that stockpiles are critically low, the implicit guarantee behind the dollar begins to erode. Quietly, at first, then all at once. For the serious decision-maker sitting with this analysis today, the strategic warning is not complicated. It does not require a PhD in economics or security clearance to understand. It requires only the willingness to see what is already in motion. Energy costs are rising and will continue rising. Supply chain dependencies built on Gulf stability are now structurally vulnerable. The dollar faces a credibility test it has not faced in a generation. And the assets that perform when systems fracture, physical gold, physical silver, hard commodities, non-dollar stores of value, are already moving. The cascade has begun. Most people will not recognize it until it is too late to reposition. The ones who recognize it now have a narrow window. History does not remember the people who watched the warning signs and waited for certainty before acting. It remembers the ones who understood that by the time certainty arrives, the opportunity is already gone. The radar is dark, the Gulf is blind, the cascade is moving. The only question that remains now is whether you are positioned for the world that is coming or still waiting for the world that no longer exists.